Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our favorite show, the Primary Vision Frac Spread Count. And on this one, we're just going to talk about frac spreads, U.S. completions, and then we're going to look at ducts and rigs just to go a little bit more in depth in terms of where we sit right now. And then we're going to go and talk a little bit more about inflation across the food side, and then the most recent triple R cut from China, which we talk about in our econ show, which again was something that we were predicting and saying was going to be the most likely outcome, but we'll discuss that a bit more when we get to it. So to kick it off, we had an increase of 4. So our the frac spreads went from 234 to 238. So we're starting off the first full week of July, or Q3, fairly strong. It's something that we think is going to continue to have that steady grind up. And when you look at rig additions and crews, we're seeing a very steady one here, one there, and we're seeing a pretty steady increase. And it's telling because we're not seeing any declines. It's not like we're seeing, we're going to pick one up for a month and then lay it down, or pick up this crew for a month and then they're going to go back to the yard. It's going to be a very steady as she goes increase over really the last 6 months of the year. So when we look at some of the backdrops, and not to give away too much, but we had some increases in Appalachia. We had some increases that are starting to roll through in the Williston. And that's the one that we want to watch the most, because the Williston is where we think we're going to get a decent amount of new activity over the next few weeks as we start to see that accelerate. The Permian has been held fairly stable right now, and we think that's going to start to see its increase as we progress through July. And I think it's important to understand kind of some of the differences right now, because we are about 141 off of 2019. So if you think about where we sit today and where we were then, we're 141 on the national side. Now, when you look at oil versus gas, we have seen a much less activity getting added on the gas side as we have on the oil side. So when you break it down in terms of oil versus gas, it's actually a little bit tighter when you consider kind of where we sit and where the focus is. Now, when you look at 2019, we were also running to really hit about 13.5 million barrels a day. Where did we end up? 13.2. But you have to think about what companies were preparing for, what they were drilling for. And we're just not there, and we're not going to get there because there isn't that level of demand for U.S. crude. And so that's where we have to look at some of those shifts that have happened over time. So when we look over the last 3 months, you can see that steady increase, limited downtime to the steady increase. And we think that's going to accelerate a bit, where we're going to get a very consistent 2, 3, 4 additions. Maybe we get one week down where they're moving equipment from one spot to another, but fairly stable increases as we really approach 250, 255. And then we expect to get one more surge above that. But that's kind of that near-term target, just based on the equipment available, what's been hired for, because that is really the biggest problem is when you're talking about hiring. Where is the labor? Are they trained? Do they need to get trained? A lot of these things are going to be very important as we see this steady increase, just because we expect to see a little bit of an acceleration as we go through what has historically been, or seasonally been, a very strong period of time, really increasing through the end of June, but then seeing pretty steady increases up and through August, and then seeing that August, September, and really into October staying fairly strong. And then you start to see the seasonal declines as we go into November and December for the holiday, and obviously just weather in general. Now, the other one that we've talked about whenever the new data comes out are ducts, or drilled but uncompleted wells. So these are wells that the rig went to, they drilled the hole waiting for the frac spread to come up and complete the well, or fracture it to bring it onto market. And that's why when we talk about what we do versus what rigs do, the frac spread count gets you much closer to the actual production number. Because when you think about, once you fracture that well, you're going to bring that online. You're going to want to have that come on. And that's why we're much closer to the actual production number, about 30 to 60 day lag, just given, when the frac spread shows up, we show it as active. Then you have to complete the well, bring it online. So there's usually that small delay. But again, it's not the 6 months, 8 months, 9 months that typically you have for a rig. But this is also a key component is we had a lot of DUCs. We had a lot of drilled but uncompleted wells, because if you look at from 2018 into 2019, there was a huge acceleration because the view was that we were going to continue to grow. We were going to start to see some of that acceleration. And our call was we are overshooting demand, both internationally, but also domestically. Remember, the U.S. refiner typically operates at an API gravity level of 33 to 34. And the U.S., especially these specific shale basins, are producing between 42 and 48, depending on if you've gone through a splitter or not. And splitter just takes out some of the lighter ends and brings down the API anywhere from 2 to 3 points. So it would make sense to see some of this normalcy back to where we were in 2018, working through some of this excess, saving some money, trying to bring in some additional cash. And let's be fair, we haven't seen cash flow in this industry in how long? So it makes sense to, hey, let's keep the rigs a little bit depressed. Let's bring back some of those frac spreads, arrest the decline curves that we had from 2020, hold the line and start to grow at a steadier rate, not at a rate where we're going to touch, 15 million barrels a day, but something that I think is going to be very sustainable of 11.5 to 11.7 million as we go through the rest of this year. And this is just looking at some basins and keeping it on separate lenses and levels, but let's streamline it a bit. Let's look at where we were in 2018 and where we are now. And this you can kind of see where we've started to come back into and how we've normalized more along those levels. Now, Haynesville has gone up a bit. We'll start to see that complete a bit more. But the Permian has worked through some of that excess that was built up in 19 and even into 20. And now you're starting to see that get worked down. And then on the national level, we're coming back into a fairly, what you could say is a more normal level for the level of production and activity that we have, because you always naturally have a DUC count, because you don't want to have the rig or the frac spread right on top of the rig. You want to have a little bit of space. You want to have a little bit of working room. And that's where you have that natural DUC count that typically exists. So this is really just showing how the focus has been on production, but we're going to start to see more of a pivot into rigs and bringing those rigs back to action. But when you talk about rigs, it's important to think of, and we'll zoom out because people will complain that we're only looking at the last 18 months. But when you look at what is, when you look at what has happened, it has been a very steady increase. And the reason why it has to be steady is you have labor. How sticky is this move in crude? What do your costs look like? What is the cost of steel? What is the cost of diesel? What is your inherent cost to figure out what should I charge? What am I getting paid? And if you're an E&P, where am I drilling? What makes sense given what our profiles look like? So it takes time to bring back a rig, but it's been a very steady increase. Almost looks like a nice little algo 45-degree angle. And you're seeing those movements back up. And we're going to continue to see the additions through Q3 as we have new additions coming on that are slated for this CapEx cycle. Now, pulling out a bit, you can see just where we sit in relation to previous. So given we have that DUC count that we've been working through, but you're going to have to start to see that slow down and not ripping through those DUCs at the same level. You're going to have to start to see the additions, and we have seen that. We're back to essentially the lows that we hit in 2016. But when you consider what we're targeting now in terms of a growth profile, or I should say lack thereof, you're not going to need the same type of rig additions to maintain the current level of production and even a little bit of growth. You're going to have something a bit more muted. And this is just looking at crude oil. And you're also talking about something where there's a certain amount of learning curve, time has gotten shorter, but there's also a certain point where you can't go too fast because this is still steel. You're still dealing with, friction, and you'll melt the pipe. So, or the drill bed. So there's also a certain amount of getting to the period of, this is really the fastest we're going to go. And we've really gotten to that point. And if anything, we'll probably start to get a little bit slower as you bring on, new labor, new workers. You're not going to have all new workers on one rig. I laugh, but it's really not funny because it's super dangerous. So you're going to start taking some of the seasoned rig hands. You're going to take some of the seasoned guys off of frac spread crews, and you're going to put them onto their own crew. And you're going to give them new employees. You're going to give them new responsibility. But what do we know about teaching new employees? It takes time. And when you're thinking about something that is risky, depending on how it's being done, dangerous in its own right, you want to make sure you're teaching these guys the right way, so that you're gonna lose some of that time. So again, that's something that has to be considered when you're looking at the additions of rigs over the next few months, which will be and continue to be a very steady increase over the next 3 months. So then when we look at some of the inflation side, because there's, when you think about crude and we look at where prices are, we've seen a lot of that inflation come through, and we continue to see it hit, on a very continuous basis. I did an opinion piece for the Politics today. And this is just kind of driving home a little bit differently because I wrote about Sudan, Lebanon, and Iran, and you can see just where they sit in 2021 as the most vulnerable to food inflation. They round out the top. So we're talking about some serious unrest or potential for unrest because of some of these shortfalls. Now, international food prices are set to rise 12% this year, according to the World Bank, which is the fastest increase since 2011. And remember, 2011, Arab Spring, there's nothing that will bring about conflict faster than a shortage of food and a shortage of water. And right now, we are really looking at both. So when you think of Yemen, Sudan, and Lebanon are the most vulnerable just based on their food import inflation, which is just cost relative to GDP and income per person. So when you look at just the income, and this comes into inflation, the inflationary levels on their end, the Henke Index has been very good in terms of identifying just how elevated a lot of these are. But this just gives you an idea of where things sit. And I just wanted to highlight India right here at number 21, just because there is a lot of risk when you think about how is India going to progress. They based on the data that came out today, preliminary for June, they had an increase in gasoline demand, a decrease in diesel demand, and that's going to be one to watch. Where's diesel and where is gasoline? So gasoline is up versus year over year, but it's still not where it was in 2019, 2018, and now in our insights, we looked at some of those India flows, and just to give a little bit of preferential treatment, we'll talk about that on the show next week, just so you can see just kind of where India sits and what some of those limitations are on a seasonality level, because I think that's a very important way to think of things, because you have to consider the season that you're in. Just like when we talk about gasoline in the U.S., everyone is talking about this huge surge in the EIA data, but then when you turn to GasBuddy, Descartes, the Department of Transportation, we were right in line with previous or a little bit below, depending on which number, where GasBuddy had a 9.6 million barrel estimate, Descartes had a 9.55, and to be fair, Descartes has been over by about 200 to 300,000 barrels a day versus the EIA. The Department of Transportation had us, right at 2019 levels. And so you have to consider what was cyclical and what was structural. So when we talk about this, and we talked about it a lot on the EIA show, there's also that structural problem with the shortages, trying to rush to get some of this product, which, essentially increased the pull from where the EIA is counting. And there's going to be some fluctuation in that number. So we will see that drop. But seeing that kind of demand really is just what is the inflationary impact going to be? Where does $3.15, how do people adjust? And just based on the data that we've seen, that we've been showing, we're going to start to see a little bit of a slowdown as vacations cool off. This was kind of that last push. And now, and given July 4th is always the peak, and then you kind of go sideways from here. So we think it's going to come down, go sideways, but it's not just the U.S., because when you look at some of these countries, especially India and China, when you look at just where some of their exposure sits, inflation's going to be a real problem. And as inflation grows, because we've shown how India's prices are at a record levels, China is seeing prices go up. They're trying to cut prices. We've seen some increases in Brazil. There's a lot of fluctuations, which is just going to be compounded because do I need to drive or do I need to feed my family? And that's where you're going to start to see some of this money shift, and you're going to see some of those slowdowns on what that demand really looks like. Now, Bloomberg had a really good article. I picked this one just because this is diapers. I have 3 kids. I know what diapers cost, and it was always painful to actually pay for them. But when you think about how diaper prices have gone up, and when you looked at Procter & Gamble, you look at Kimberly, they're all taking prices up, and it's happening over the course of 6 months. And this is just showing something that everyone is buying day in and day out. If you have a child that under the age of 2, or I should say 2.5, depending, based on my experience with potty training, this is going to be a daily expense. This isn't I'm buying a couch, I'm buying a car, and this is a daily expense that is going up 10, 15%. And if you look at just where they hasn't stopped going up. And this is not a year over year. This is a year over year look. But when you're looking at this over time, and just based on where the Procter & Gamble and Kimberly are, you're going to see a steady increase through the end of the year that is going to be anywhere from 7% to 15%, depending on the item. So this is something that is going to hit people very specifically. And how much of this inflation is going to be covered? Where is that going to shake out? And I think that's an interesting component as to just an everyday item that you can't really live without, but how are you going to afford it? Are you going to drive a little bit less? Are you going to go to Chipotle or Panera or, Pizza Hut less? How are you going to change your spending patterns? And just given where savings, as we keep talking about that savings chart, savings still remains skewed much to the 20% and above, and especially in the 1%er category, leaving the people that would actually count pennies to figure out how many diapers, they don't have that savings, and that's something that is going to have to be watched when we're talking about inflation. And this just puts it into perspective on food inflation when we talk about it being at the 2011 levels. You can just see where that inflation sits and how painful that has been, especially on something as stable as corn. When we look at wheat, corn, and some of the others, you can see just how that continues to press higher and why this is a bigger problem. And it's always going to change based on where we're talking about and who we're talking about, because this is going to be an underlying problem that is not going away anytime soon. Now we have WASD for Latin America coming out. We'll see that come down. We talk about that in our insights today, but these are some of those I think key problems that are going to become a bigger and bigger issue, especially as some of the numbers get taken down and we see prices move higher or at least stay elevated, keeping that pressure on the underlying, especially the emerging markets. Now, just a quick backdrop on China. We had said that it was a likely setup where China was going to cut their RRR or the reserve ratio, and we talk about that and what that is in segment 5 of the Econ show. So I don't want to go over that too much. But this is just where we're seeing on some of that social financing side to give you an idea of where some of that finance is coming in. When we look at the yuan bank loans, that's just going to open things up because you're going to cut the rate, which just means that they're going to be able to lend more. So we'll see some of that go back up. Now, when we think about what this is, so what did they do? They cut 0.5 percentage points, so 50 basis points to the required reserve ratio, which will inject 1 trillion yuan into the banking system, which is going to help growth that's poised to slow in the second half. So we saw it slowing already. They're trying to get ahead of this, but remember they've talked about their limitations on new bonds, trying to slow down some of those credit impulses. So one of the things that we had highlighted yesterday was in terms of the medium-term lending facilities. So the MLF has a total of 1.1 trillion yuan in the next 2 months expiring. So if you think about what they're going to try to do, or, and not to say that they're going to do it perfectly, because it's going to be hard to manage that liquidity, but you cut the triple R to that 50 basis points, you put 1 trillion yuan into the market using the banks, and then on the MLF facility, you have a part of that expire. So you essentially stop the decline of credit impulses, but you really try to protect the increase on credit impulses, and you try to manage that liquidity by just changing the injection points. And the whole concept is trying to support the micro, small, and medium companies and enterprises, because that's where they're still seeing a lot of struggle on the economic level, or I should say the economy level, which is leading to an economic slowdown, that they're trying to not so much ignite higher, but just protect from weakening too much and getting to a point where it's just a bigger hole to dig out of. Because we still don't see the consumer doing all that much, and we still see that struggle within the corporate side, which is, again, one of the big things that they're looking to address with the triple R versus the MLF facilities. And this is just a way to provide that injection. So I know we covered some wide-ranging topics, from food to completions to Chinese investment rates. But these are things that they may not sound linked, but they really are. Because if you think about China and you think about some of the slowdowns, when we look at commodity prices versus some of these credit impulses, they're typically fairly correlated. And you want to say, okay, well, if they stop going down, well, where is that going to leave commodities? How are commodities going to react? And where is that going to put demand, especially when you start seeing inflation appear in other places, more importantly on food, which is going to be a big driver and going to make people make decisions. And then I just think it's interesting to look at diapers, just because people complain that, oh, well, couches are going to get cheaper, and I only buy couch once a year. So, as that comes down, but, it's more important to look at the prices that aren't going to change, because I know in my experience, companies will be quick to increase prices, but they'll be very slow to take them down, if at all. And that's, I think, a key component when we think about this recovery and what that looks like on the go forward. So if you have any questions, we always love to hear from you. If you want to hit me up on Twitter, leave a comment or email us. We'd love to hear from you. Hopefully you have a great weekend. It was a little soggy here today, but it's getting better. So hopefully we'll have some nice weather to make up for a week of Friday. So have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.